So I've been consistently getting this question from you guys in the comments, in my Discord, in my Instagram DMs. And the question is, should I wait to start investing? The stock market is down. Should I wait to start investing? The stock market is up. It's too high. Should I wait to start investing? Let me show you something fascinating. This is a dot on a screen that represents $6 million. And this is a dot on a screen representing $0. In between these two dots are years and years of consistently investing little amounts of money every month over a long period of time. So let me just explain exactly what you're looking at here. This is a chart that shows compounding growth. If you were to invest $500 per month over a 45-year period at a 10.5% return, this is what you would end up with before inflation, $6 million. And assuming that you did this inside of a Roth IRA, all of that money would be completely tax-free. But many of you watching don't have 45 years to invest, right? Perhaps you have 35 years or 25 or 10. It doesn't really matter because the question, should I wait to start investing, is a definitive no. You should not wait to start investing, and here's why. The first reason is because you're missing out on compound interest. Compound interest is interest that you earn on top of interest. And so it's like you're making money just for making money. A perfect example of compound interest at work is this chart from earlier. As you can see from the chart, you start at $0. But as you start to invest your money slowly and slowly, the interest that you earn from your investment will start to compound. And that compounding is what creates the exponential growth. And this exponential compounding growth is the reason why in just 2 years, from year 43 to 45, your money was able to grow $1.2 million in just 2 years. But that same exact $1.2 million took 30 years to grow from 0 to 30 years. So can you see the power of this, of compounding interest? This is the first major reason why I think that you should not wait to start investing, because the longer you wait for the perfect time to start, the less time your money has to grow and compound. And just to really help illustrate this point, this is a chart showing the compounding growth if you have 35 years to invest as opposed to 45 years. And so 10 years less than the previous chart that we looked at where you had 45 years to invest. On this chart, you can see that after 35 years of investing $500 per month at a 10.5% return, your investment would grow to a little over $2 million. That's an entire $4 million less than if you had just an extra 10 years to invest. And so the bottom line is this: stop waiting to invest. You're wasting precious time. The quicker you can begin investing, the more time your wealth has to grow in the stock market. Now, in saying that, I understand your concern. The stock market can seem pretty tricky. I mean, how are you supposed to know when the right time is to begin investing? Especially when it looks like this: up, down, up, down. And then you see articles like this literally every day predicting the next biggest crash or the next greatest bull run. The problem though is that all of this information is just noise, and it's really easy to be distracted in the short term by looking at what the stock market is doing today, instead of taking a step back and looking at the bigger picture. And that's actually the next reason why you should not wait to start investing, because it's impossible to time the market. And that's literally exactly what you're trying to do when you're waiting for the perfect time to start investing. Some of the best investors in history had no interest in trying to time the market perfectly. In fact, Peter Lynch himself has said far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Okay, so if you shouldn't try to time the market, then what exactly should you do? I'd like to introduce you to dollar cost averaging. Dollar cost averaging is when you invest the same amount of money into a stock or index fund or ETF on a regular, consistent basis, regardless of the price. And so if the stock market seems high, like it's about to pull back, don't wait, invest. If the stock market seems low, like it's gonna keep on dropping, so what? Invest. Let's say, for example, that you watched my video about starting a Roth IRA. And so you started one and you plan on making regular contributions every single month to maximize that $6,000 contribution limit. With dollar cost averaging, you would just invest $500 per month into the same index fund or ETF or stock on a consistent basis, regardless of what the latest scary headline says about some hypothetical upcoming crash that never happens. Now, I get it, okay? You've got bills to pay, rent, mortgage, childcare. You have to put food on the table. Investing for your future is not the first thing that comes to your mind when you're trying to figure out how to survive in the now. But please, for those of you who are waiting to start investing, you're making these excuses as to why you can't start investing right now. I am pleading with you. I am begging you just to start investing. Have you guys seen that video of the guy from back in 2013 begging people to buy just $1 worth of Bitcoin?
If you really want to become wealthy in the future, I would suggest you take $1 frickin' $1 buy some Bitcoin.
If the people who saw that video back in 2013 took him serious and bought even just $100 worth of Bitcoin, that Bitcoin today would be worth well over $300,000 from just a $100 investment. Now, I'm certainly not saying that if you invest $100 into the stock market that in 10 years it'll be worth six figures. Unfortunately, that's just not the case. But if you invested $500 per month, 200, 150, it doesn't matter. If you invested any amount of money per month consistently over a long period of time, then I promise you, I guarantee you, your future self will thank you. Because even investing just a little bit each month will still have the compounding effects, even if it's on a small scale, but that compounding will still grow your wealth relatively well. So, how do you begin? What's the action plan after you watch this video? First things first, I want you to create a goal. I know it sounds boring, but just hear me out, okay? What exactly are you investing for? Retirement? To buy a house, to go on vacation next year? Knowing your exact reason for investing is gonna really help you with the next step, which is deciding on the type of investment account to open. If you're investing for retirement, right, it wouldn't really make sense to go and open up a standard brokerage account. You would wanna open up a retirement account that comes with tax advantages. And so something like a Roth IRA, or whatever you have in your country that's equivalent to a Roth IRA. If you're not investing for retirement, but for another reason, like for example, you want to invest in dividend ETFs to give yourself extra income, or you're trying to buy a house in the next decade, and so you want to begin investing your money for that. In those situations, a standard brokerage account would make sense. Then after you pick your account, decide where you want to actually open up this account, like what broker. I talk about this a lot in my videos about my favorite brokers to use to invest in the stock market. I actually made an entire video dedicated to the best investing apps that you can use, and I'll link that down below and above. Finally, decide what you want to invest in. If you've been watching this channel for any amount of time, even just a short period of time, then you'll know that I am a huge proponent of investing in index funds and ETFs. I personally see no reason to go and invest in individual stocks unless that's like your job or you just really enjoy doing it. But for the rest of us, low cost, diversified, high growth index funds or ETFs is the absolute best way to invest in the stock market. And for the vast majority of people, investing in a total stock market index fund or ETF, something like the Vanguard Total Stock Market ETF combined with a slightly more aggressive ETF such as the Vanguard S&P 500 ETF is the way to go. And with these two ETFs, you could do like a 50-50 split or a slight variation of that. You could do like 40-60 or 60-40, whatever you prefer. Now, this is for the majority of people, okay? For those of you who are like me and prefer to be a little bit more aggressive and you like ETFs like triple Qs or VGT, then you can invest in those things as well, and that's fine. Now, if all of that just really confused you, then I would say keep it simple. Just put all your money into a simple, low-cost total stock market index fund or ETF, something like VTI or FSCAX or VTSAX. All of those are really good options and will give you super broad, diversified, low-cost exposure over the entire US stock market. And honestly, you just can't go wrong with that. Anyways, that's it for this video. Guys, you're amazing. And as always, I will see you again very soon. Take care.